Okay, let's continue our discussion on valuation. So we talked about two kinds of valuation methods. The first one is WACC method. The second one is APV method. WACC method basically says that you will first look for cash flows, and then you will discount those cash flows with WACC. And then for APV method, APV basically means adjusted present value. So you will first start with the unlevered value, and then you will adjust that unlevered value. How do you make the adjustment? Well, you will calculate the present value of the interest tax shield, and then you will add the unlevered value and the present value of the interest tax shield, which will give you the levered value. Okay, now let's see this example here. Consider again Avco's acquisition from the last two examples. The acquisition will contribute $3.8 million in free cash flows the first year. And this free cash flow will grow by 3% per year. The acquisition costs $80 million, and this cost will be financed with $50 million in debt. And compute the value of the acquisition. Use the APV method. And we assume Avco will maintain a constant debt equity ratio for the acquisition. Assume 6% interest rate and 40% corporate tax rate. So obviously the first step of the APV method is to find out what is the unlevered value. And you can see that this is pretty easy, right? So we can see that the free cash flow in the first year is $3.8 million. And then we have this growth rate, which is 3%. So the only number we need is the unlevered cost of capital. And we have actually calculated this number. So let me show you where it is. So this is the unlevered cost of capital for this firm, 8%. And then using this 8% unlevered cost of capital, we can calculate this acquisition's unlevered value. Right. So basically here, the unlevered value would be the first year free cash flow divided by 8% unlevered cost of capital minus 3% growth rate. And this gives us $76 million. And now the harder part. We have to find out the present value of the interest tax shield. So let's think about the timeline here. Okay, from the problem, you can see that initially, the firm would take $50 million of debt, and the interest rate is 6%, and the corporate tax rate is 40%. So this basically means that here we have a debt level of $50 million. And then remember that we assumed the interest payment will come at the end of the year, right? So basically it means the interest expense here would be 50 times 6%. Remember 6% is the interest rate. And then the interest tax shield equals interest payment times corporate tax rate. So times 40%. This gives us the first year's interest tax shield. Right, so this is a simple calculation, and I believe this will give us 1.2, I guess. Okay, let me see. This is 3. 3 times 40%. Yeah, it's 1.2. Okay. Now, think about this. If the first year's interest tax shield is $1.2 million, what is the second year's interest tax yield, right? So what is interest tax shield in the second year? Well, if you think about it, you can see that the firm's free cash flow has a constant growth rate of 3%, right? So let me write it here. The firm's free cash flow increases by 3% per year. If you think about this, this basically means the firm's levered value will increase by 3% per year, right? And if the firm's levered value increases by 3%, then it basically means debt has to increase by 3% per year. And this implies the interest tax shield will increase by 3% per year. So this basically means that just like the cash flow, the firm's interest tax shield has a constant growth rate of 3%. So this basically means the second year's interest tax shield equals 1.2 times 1 plus 3%, right? So basically, if we want to value the present value of interest tax shield, you can see that we have the following data points. First, we have the first year's interest tax shield, which is $1.2 million. And then we have the growth rate, and it's a constant growth, which is 3%. And then the only thing we want to know is what kind of discount factor we should use to discount these interest tax shields. And we have learned that if the firm maintains a constant debt equity ratio, then we should use the unlevered cost of capital to discount this firm's interest tax shields. So here you can see that we should use this 8% discount rate, which means the present value of the interest tax shields is 1.2 divided by 8% minus 3%. So this should be, I don't know, 6? No, it should be $24 million. So this is $24 million. And then you can see that we have calculated that the unlevered cost is $76 million, and the interest tax shield has a value of $24 million. So the third step, that is, we will add these two numbers to get the firm's levered value. It should be 76 plus 24, which is $100 million. And you can see that, you can verify that this number is the same as what we have got from the WAC method. You can see that this APV method is a little bit more complicated compared with the WAC method. For this problem, you can see that I would say the only caveat here is you have to understand the interest tax shield increases at a constant growth rate of 3%, just like the cash flow. And this is the logic here, right? So these several steps explains why interest tax shield increases at 3% constant rate. Right? I would say this step is pretty important, right? You have to understand why the levered value increases at 3%. Okay, maybe I should show you why the levered value increases at 3%. Now, if you think about V0, right? The levered value on this initial date equals the first cash flow, which is 3.8 divided by WACC minus the growth rate. And then the levered value on date 1, which is VL1, equals 3.8 times 1 plus 3% divided by WACC minus G, right? You want to use 3.8 times 1 plus 3% because we know that cash flow growth grows at 3% rate, right? Because the cash flow on date 1 is 3.8, and on date 2 it's 3.8 plus 3.8 times 1 plus 3%, right? So obviously if you compare this and this, you can see that the levered value increases at a rate of 3%. And then you could argue that if levered value grows at 3%, then debt should grow at 3% if the firm wants to maintain the constant leverage ratio. And this implies interest tax shield will grow at 3%, right? Okay. Now let's talk about the flow to equity method. So this is the third method to value a firm or to value a investment. The third method is different from the first and the second method because here we really only focus on equity. So it's essentially a method of equity valuation. Generally, you will first calculate the free cash flow available to equity holders, and then you will discount the free cash flow to equity holders using the equity cost of capital. So you can see that this is definitely different from WACC, right? Think about the WACC. When you're using WACC method, you will actually calculate free cash flow and then you will discount at WACC. And if you're using the flow to equity method, you will calculate the free cash flow to equity holders. And then accordingly, you should discount these cash flows with the equity cost of capital, right? I would say conceptually, free cash flow is a measurement of cash flow at firm level, right? So you should discount free cash flow using the firm level measure on the cost of capital, right? That is, you should discount FCF using WACC. And then free cash flow to equity holders only accounts for the cash flow for equity holders, right? It's specifically related to equity. So that's why you should discount these cash flows using the equity cost of capital. Okay. Clearly, if you want to use this FCFE, that is free cash flow to equity method, you will have to first calculate the free cash flow to equity. So here we have this formula here. So basically you can see that to calculate the free cash flow to equity holders, you will start from the net income. And then you will add back depreciation. And then you will minus capex. And then you will minus the increase in the net working capital. And then you will plus net borrowing. So what is the idea here? Well, net income essentially measures earnings to shareholders. And you will add back depreciation. This is obvious. It's exactly like how you calculate free cash flow, right? And because you spend money on capital expenditures, so you have to minus capital expenditure. And if you increase your net working capital, then it means that you invest some money into your net working capital. So you will have to minus the increase in net working capital. Now, what is net borrowing? Well, net borrowing essentially measures the change of debt, right? So you can see that the formula tells you that net borrowing at date t equals date t's debt minus previous days or previous year's debt. So this is quite intuitive, right? If you think about this, let's say if in 1990, right? Oops. If in 2020, debt is, let's say it's $100 million, right? And then let's say in 2021, debt increases to $150 million. So essentially this means in year 2020, the firm raised $100 million of cash from debt. And then in 2021, the firm would raise additional $50 million, right? In this case, it means that this additional cash will increase the free cash flow to equity holders, right? So it's actually pretty intuitive. Okay, let's see how could we calculate the free cash flow to equity, right? So let's say we just look at one specific year, right? Let's say we focus on the first year, and we start from net income. And you can see that you have to add back the first year's depreciation, $6, and minus the net borrowing, which gives you $9.98 million, which is the first year's free cash flow to equity. Now, you might wonder, how can we get this number, right? Well, this row gives us the numbers about net borrowing. And we understand net borrowing can be calculated from the changes in the firm's debt. So let me open the Excel. Oops, where's my Excel? And let's see how can we find out the firm's net borrowing. So we discussed debt capacity in the last lecture, right? So for example, okay, let me change the red color. So you can see that in this row, we have the firm's debt capacity from the first year, year 0, to the fourth year. And based on the debt capacity, we can basically calculate the firm's net borrowing, right? So if you look at this first number, well, this essentially equals the level of debt here minus 0, right? Because in the beginning, the firm did not have debt. And then the firm increases its debt level by $30.62 million. Okay. Now let's, So how can I find an eraser to remove this thing? this one. Great. Now let's look at this 9.62, right? Again, it equals this year's debt minus prior year's debt. So it essentially equals this number, right? Minus 30.62. When you're using this Excel file, it's pretty easy to use. You can see that you can basically find the formula used in these cells. I don't know whether I can do this, or I don't know whether I can find out the formula on the iPad. Let me try. I don't think. Oh yeah, you can see that you have the formula here. Oops. Oh boy. Okay. You have to try this at your home, because I'm on an iPad. It seems it's pretty hard for me to find out the formula used here. Oh, finally. You can see that on the left corner, right? Left upper corner, you can see the formula here. And this formula will basically tell you how to calculate net borrowing. So I would encourage you to try to play with this Excel file on your computer. Okay, let's go back to our lecture note. Okay, good. Okay, so we have finished the task of finding out free cash flow to equity. And now we talk about the second way to solve free cash flow to equity. So basically we can adjust from free cash flow, right? So we will start from free cash flow, and we will minus the after-tax cost of interest payment, and we will plus net borrowing. This formula is also quite intuitive, right? Because free cash flow essentially means or measures cash flow to both equity holders and debt holders. And now we just want to find out the free cash flow to equity holders. So we have to minus the free cash flow to debt holders. That is, we wanted to minus interest payment. However, we know that there is tax shield from interest payments. So we should minus after-tax interest payment, right? So that's why you have this 1 minus tau c here. And again, you will obviously have the same guy, this net borrowing. Because if you have positive net borrowing, it means the firm borrows more money. It means the free cash flow to equity holders will be higher. Okay, so now we would start from the free cash flow. So let's see, where did we get these free cash flows? Oh, you can see that we get this free cash flow from the first table, right? Here. And then we will look for the after-tax interest expense. Okay, I guess it's better for me to just use this Excel file. So we have these free cash flows. And then we will want to deduct the after-tax interest expense. Right? How do you get this? Well, I mean, it's pretty easy, right? You would just use 1 minus the corporate tax rate times the interest expense. And obviously you can find the firm's interest expense from the first, so where's the interest rate? Where's the, oh yeah, it's here, from this table, right? So if we check these numbers, you can see that for year one, the after-tax interest expense is 1.1, which equals 1 minus 40% times the interest expense. And it's given by 1.84. And you can verify that the calculation here checks out. And net borrowing, well, we have the same guy here, right? We have discussed net borrowing. And now, given all these numbers, all these components, we can calculate the free cash flow to equity, right? So, for example, for year one, the free cash flow to equity equals the firm's free cash flow minus the after-tax interest expense plus net borrowing. And you can see here that net borrowing is negative, so it's minus 6.92, which gives us 9.98. Clearly, you can verify that these two methods should give us the same result, right? So this row should be the same as this row. Okay, now I will change back to the lecture note. So we basically finished the task of finding out the free cash flow to equity holders. That's like the first step, right? You have to get cash flows. And then the clear second step is to find out the discount factors, the discount rate for the free cash flow to equity. And we said you could just use the equity cost of capital. And the lecture notes give us the firm AVCO's equity cost of capital. It is 10%. So what you will do is you will discount these numbers with 10% discount factor, right? So this is exactly what this equation is trying to do here. And you can see that the negative present value from this free cash flow from this project is, the net present value of this project is $33.25 million. You can verify that this NPV is the same number we have got from the WACC method and the APV method. Okay, the little summary here. Again, three-step process. First, you will find out the free cash flow to equity. And then you will find out the equity cost of capital. And then you will discount the cash flow, use the equity cost of capital. And this will directly give you the net present value of the project. So we have basically talked about these three methods. And you can see that the easiest one, if your sole purpose is to find out the present value of the project, you can see that WACC is generally the easiest one. And then we have this APV method. And you can see that this is more complicated because you have to explicitly find out the present value of interest tax shields. But you can see that this complication also offers the benefit. That is, you can clearly see the components of your valuation, right? You can see both the unlevered value and you can also see the value of the tax shield. And then you can see that the flow to equity method is also a little bit of complicated because you have to find out the interest expense and you have to find out the net borrowing because you need these two numbers to calculate the free cash flow to equity holders. That is, for this flow to equity method, the difficult part is to calculate the free cash flow to equity. It's more complicated compared with just calculating the firm's free cash flow. And you can see that the benefit of this flow to equity method using the free cash flow to equity holders is you can get this explicit calculation of equity. So it's essentially a equity valuation method. Okay, now let's see this example again. We're discussing this example that Avco makes a acquisition. Right? So we know that the acquisition will contribute $3 million in free cash flows the first year. And then the constant growth rate would be 3%. And the acquisition cost of $80 million will be financed by $50 million in debt. The question is, what is the value of this acquisition using the FTE method? And we also assume the interest rate is 6% and corporate tax rate is 40%, cost of equity is 10%, and the firm maintains a constant debt equity ratio. So you can see that the cost of equity is given, right? The only thing we need to do is we want to find out free cash flows. Okay. Now, let's first draw a timeline. Okay, so on day 0, what you can see here is if we want to find out FCFE, that is free cash flow to equity on day 0, it equals free cash flow minus the after-tax cost of interest expense. I'm using IE to represent interest expense, plus net borrowing. Well, on day 0, the free cash flow is 0, right? And there is also no interest expense. Oh, no, it's not 0. I forgot that on day 0, there is capital expenditure, right? So the free cash flow on day 0 should be minus $80 million. And then the interest expense is 0. What is net borrowing? Well, the firm borrows additional $50 million. So we should see the net borrowing here is $50 million. So it's minus 30, right? Okay, now we have the first cash flow, which is minus 30. Now let's think about date 1's free cash flow to equity holders. So now let me use again free cash flow minus the after-tax interest expense plus net borrowing. Okay, now what is the free cash flow on date 1? We can see that the problem directly gives us the answer, right? It's $3.8 million. What about interest expense? We can see that on date 0, the firm took on a debt of $50 million, and the interest rate is 6%. So you can see that interest expense is $50 million times 6%. I think it's 3. Yeah, it should be 3. Right? So it's 1 minus 40% times 3. Okay, let me see what is the amount here. It's 3. Okay, yeah, I'm right. Now, net borrowing. Well, this is the tricky part. So we know that debt 0 is $50 million. Now, what is D1? What is the firm's debt on date 1, right? Well, the debt is just $50 million times 1 plus 3%. So essentially I'm saying that debt grows at 3%. Why do we have this result? Well, the argument is the same as before. The reason is because the firm maintains a constant debt equity ratio. So you can see that we now can have the same kind of argument. That is, this project's free cash flow increases at 3%. Its value increases at 3% each year. And then to maintain the same kind of debt value ratio, debt has to increase at 3%. So you can see that net borrowing equals the difference between D1 and D2. And you can see that the difference is 50 times 3%, right? So now we can have the FCFE on date 1. This should be 3.5, right? So it's 3.5. Now, what is the free cash flow to equity holders at date 2? Well, my argument is the free cash flow to equity holders at date 2 should be 3.5 times 1 plus 3%. So essentially I'm saying that the free cash flow to equity holders increases at 3%. So why do we have this result? Well, the reason is you can see that the firm's free cash flow increases at 3%. And the firm's interest expense increases at 3%. And the firm's net borrowing will also increase at 3%, right? So this basically means free cash flow to equity holders increases at 3%. Okay, now we have got everything we want to find out the net present value of this project. So the net present value of this project using the free cash flow to equity method is the first cash flow plus 3.5 divided by the discount rate. Is it 10%? Yes, the cost of equity is 10% minus the growth rate, right? So this gives us how much? $20 million, I think. So this is minus 30 plus 50. It's $20 million, right? Yeah, it's $20 million. So again, you can see that this problem has some caveats, right? You have to understand that debt increases at a constant rate of 3%. And then you have to figure out how the free cash flow to equity holders changes. To be more specific, you need to understand why free cash flow to equity holders increases at 3%. What you will do is you will use the formula we have learned, right? You could argue that you could find out free cash flow increases at 3%. This interest payment increases at 3%. The interest payment increase at 3% because debt increases at 3. And net borrowing also increases at 3%. Net borrowing increases at 3% because the argument we have made here, right? We have seen that there is a growth rate of 3% in debt. Okay, great. Now let's talk about the next section. So we have discussed all three methods of valuation, right? The WACC method, the APV method, and the FTE method. And all these methods, you can see that they maintain this assumption that the project has the same risk as the firm, and the project has the same leverage as the firm. And you can see that this assumption is convenient, because if the project has the same risk and leverage as the firm, then you could use the firm's cost of capital as the project's cost of capital. But you can see that sometimes a firm's project could have been different from a typical project from the firm. That's bad language. So you can see that sometimes a firm's project is not typical, which means the project will have different market risk and it will have different leverage, right? Compared with an average project from the firm. In this case, we ask how to calculate the project's WACC to be more in a more general sense. I'm using the word in a more general sense because you can see that this is a more general case, because now the project could have a different risk and different leverage compared with the firm's typical project. This basically means you cannot use the firm's cost of capital as the project's cost of capital. So what's the general idea here? The general idea here is you will want to look for comparable firms, right? If you recall Corporate Finance 2, we have discussed this. If you have a new project, and this new project is different from your typical project, then it will be hard for you to obtain data points from your own past investment or your firm's own past projects. So you have to look outside of your own firm. You have to look for comparable firms. Here, comparable firms basically mean firms with similar business, with similar risk as your project, right? Okay, enough talking. So let's look at this example here. So suppose Avco has a new project. So this project is plastics manufacturing division. So it has different market risk compared to its typical packaging business. So here, to estimate this new project cost of capital, we will have to look at other firms which have similar business and similar business risks. So now let's assume that we're lucky that we can find out there are two comparable firms. And for these two comparable firms, we will look at their equity cost of capital, their debt cost of capital, and their debt to value ratio. And using these numbers, we can find out the unlevered cost of capital for these comparable firms, right? So you can see that, for example, for firm 1, its unlevered cost of capital is 60% times equity cost of capital plus 40% times 6%. So this gives us 9.6% 6%. And for the second comparable firm, its unlevered cost of capital is 9.4%. So why do we want to use or find out comparable firms' unlevered cost of capital? Well, because we want to use these compared firms' unlevered cost of capital as our own project's unlevered cost of capital, right? So you can see that here we have two firms. So we have two numbers. And we could just use the average of these two numbers, right? So the average here is 9.5%. And we will use this 9.5% as our own project's cost of capital, right? So the cost of capital for this new project, this plastics division at Avco, is about 9.5%. And then we will calculate this project's WACC. So, remember how do you calculate the WACC, right? So WACC is, so this is one formula you can use. Or you could adjust the WACC from unlevered cost of capital, right? Or you could use this formula. Oops. So let's say we would go from the first formula. So what you can see here is basically you wanted to find out this RE, and you will need RD and these leverage ratios. Okay, so how do we find out RE? Well, we could use the theorem from Corporate Finance 2. And this is the formula you have learned from Corporate Finance 2, from proposition 2. It says that if you give me the unlevered cost of capital, and if you give me the firm's debt cost of capital, and if you give me debt equity ratio, I could tell you what is the firm's equity cost of capital. And you can see that we have got RU, right? It's 9.5%. And then we need these additional data points. So let's say this new project has a debt cost of capital of 6%. And let's also assume this project has a debt equity ratio of 1. And then you can see that using this formula, we can find out the equity cost of capital is 13%. So now we can calculate the firm's WACC, right? So what you can see here is and you can see that we have all the numbers we need. This RE is 13%, right? We just calculated. And RD is 6%. And TLC should be 40%. And we know that the firm will maintain a debt equity ratio of 1, which means this number should be 0.5 and this number should be 0.5. So this gives us a calculation of 8.3% for WACC. Now let's talk about the second way of calculating WACC from the unlevered cost of capital. And this one is easier, right? Because you can see that what you do is you're just adjusting from the unlevered cost of capital to WACC. And we know that RU is given by this 9.5%. And we know that the debt value ratio is 1/2. And the corporate tax rate is 40%. And the debt cost of capital is 6%. So WACC here is 8.3%. Okay, I wanted to make some comments about the calculation here. So remember that the first step we use is the comparable firm analysis. And the purpose of the comparable firm analysis is we want to find out these comparable firms' unlevered cost of capital. And then we will use that unlevered cost of capital as our project's unlevered cost of capital. Why could we do this? Well, the reason is because these firms are comparable. It means that these firms, they have comparable business and they have the comparable business operations. So the risk of the comparable firm's business should be similar to the risk of the project, which means the project and these comparable firms, they should have similar unlevered cost of capital. That's why you could borrow unlevered cost of capital from other firms. And then we want to calculate this project's equity cost of capital and this project's WACC. You will use the project's own leverage ratios and the project's debt cost of capital, right? Basically what I'm saying is you cannot use comparable firms' WACC as your WACC. This is clear, right? Because WACC depends on your leverage. If the comparable firms have different financing than your project, then your project's WACC should be different from these comparable firms' WACC, right? So to put it simply, you can borrow unlevered cost of capital from comparable firms, but you cannot borrow WACC from comparable firms. Obviously, you also cannot borrow equity cost of capital from comparable firms, and you cannot borrow the debt cost of capital from comparable firms. Okay, now let's look at this example here. Haskell Corp is a provider of lumber and milling equipment, and its equity cost of capital is 12.7%, and its borrowing cost is 6%, tax rate 35%, debt value ratio 40%. Estimated unlevered and WACC of the lumber and milling division. This is easy, right? We could just use these numbers given. So unlevered is so equity value ratio is 0.6 times 12.7% plus debt value ratio 0.6 times 6%. So this gives us 10%. And then WACC, so we could just adjust from RU, right? So minus the debt value ratio times corporate tax rate times RD. This would be 10% minus 0.4 times corporate tax rate times 6%. So this will give us 9.2%. Okay, now let's look at the next question. Let's say the firm wants to develop a GPS-based inventory control tracking system. Anyway, it's a new project, right? So the firm now has a new project. And then let's say the the firm Haskell, it defines some comparable firms, and these comparable firms have a unlevered cost of capital of 15%. And Haskell plans to finance the new project with 10% debt. And the debt has a cost of 6%. And now our task is to estimate the unlevered and equity and WACC of this new project. So first, as I have emphasized, you can borrow the unlevered cost of capital from other comparable firms, right? And we see that these comparable firms, they have a unlevered cost of capital at 15%. So now you can see that for this project, we should use 15%. Next, equity. Well, we will use the formula here. So RU is 15%, and the debt equity ratio is, you can see that debt value ratio is 10%, which means debt equity ratio would be 1/9. And 15% minus 6%. So this gives us 16%. Yeah, it looks like it's 16%. Okay, good. And now weighted average cost of capital. Right? So WACC would be RU minus D plus D divided by E plus D times corporate tax rate times the debt cost of capital. And then this would be so what is RU here? Okay, 15% minus 10% debt value ratio times corporate tax rate 35% and times debt cost of capital 6%. So this should give us 14.8%. Okay. Okay, now let's talk about the APV method. So we have discussed this method, and we assumed that firm has a constant debt equity ratio. And now we will relax this assumption. We will discuss two alternative leverage policies. The first is we assume the firm maintains a constant interest coverage. And then the second is we assume the firm has a predetermined debt levels. So first, constant interest coverage ratio. So basically, constant interest coverage ratio means the interest coverage is constant. That is, the firm always keeps its interest payment equal to a target percentage of the project's free cash flows. In terms of mathematical formula, it basically says that the interest paid in year T divided by the free cash flow in year T equals a constant number, K. For example, if the interest paid in year T is given by 100, and then if the free cash flow is 1,000, then you would see that the target ratio here is 10%. Right? Okay, it's pretty easy to understand. Now, how do we value the project or the firm if the project or the firm has a constant interest coverage ratio? Well, Well, this assumption of constant interest coverage ratio actually makes using APV method really convenient. So let's see. We wanted to find out first the present value of the interest tax shield because we're using APV here. So obviously we have to do this. So interest tax shield, I'm using ITS to represent interest tax shield. So we know that this equals, so how do you calculate the interest tax shield? Well, corporate tax rate times interest payment, right? And how do you calculate interest payment? Well, under the assumption of constant interest coverage ratio, you can see that interest payment basically equals this ratio, this percentage times free cash flow, right? So it's K times free cash flow. And now you can see that if we further assume both K and the corporate tax rate are constant, then you can see that this equals tau C times K times the present value of the free cash flow, right? And we learned one thing. When we want to discount the firm's interest tax shield, then we should use this unlevered cost of capital, right? If we assume the firm maintains a constant debt to value ratio. Here we have a different assumption. That is, the firm has a constant interest coverage ratio. And the result is the same. We still should discount these interest tax shields using the unlevered cost of capital. Why? Well, the argument here is actually similar, right? Remember that in the case of if the firm maintains the constant debt to value ratio, then we said that the variation of debt should be the same as the variation of the firm's value. So this means if you use the unlevered cost of capital to discount the firm's free cash flow, then you should use the unlevered cost of capital to discount the firm's interest tax shield. And now if we assume the firm has a constant interest coverage ratio, now you can see that the argument is even more obvious, right? Because you can see that, again, if free cash flow increases by 10%, then interest payment will increase by 10%. If free cash flow decreases by 10%, the interest payment will decrease by 10%. So again, the variation of the interest payment is the same as the variation of the firm's free cash flow, which means the risk of the interest payment is the same as the firm's free cash flow, which means the risk of the interest tax shield is the same as the firm's free cash flow. So if you use unlevered cost of capital to discount the firm's free cash flow, then you should also use the unlevered cost of capital to discount the firm's interest tax shield if the firm maintains constant interest coverage ratio, right? So here we should use RU, and you can see that if you discount this thing, if you discount the free cash flow with RU, then the present value of free cash flow will just give you the unlevered value, right? So essentially you can see that under the assumption of the constant interest coverage, the present value of the interest tax shield equals the corporate tax rate times this ratio K times the firm's unlevered value. And now you can see that this is really convenient because we know that the firm's levered value equals unlevered value plus the interest tax shield, right? Which means we will have this result. So 1 plus tau c times k times unlevered value, right? So you can see that this is a very nice and simple formula. Okay, now let's see this example here. Consider again AVCO's acquisition from the last several examples. And we have learned the acquisition will contribute $3.8 million in free cash flow the first year, constant growth rate 3%, and the acquisition cost of $80 million will be financed with $50 million in new debt. Now, the question is, find out the value of this acquisition using APV method. And by assuming AVCO will maintain a constant interest coverage ratio. And we assume the tax rate is 40% and ROE is 80% and interest rate is 6%. So if you look at the formula, right, VL equals 1 plus tau CK times VU. And we have tau C here, which is 40%. And what is VU? This should be easy, right? We have done this. So let's first finish the easy part. The first cash flow would be $3.8 million. And then the unlevered cost of capital is 8%. And we minus the growth rate, which is 3%. So this would give us 3.8 divided by 5%. So I think it's 76. It's $76 million. And now we want to find out this guy. What is the K here? Remember that K equals interest payment divided by free cash flow, right? You can see that the problem does not directly tell you what is K, but we can back out K using the firm's interest payment and its free cash flow. So let's just look at the first year, right? So in the first year, the free cash flow is 3.8. What is the interest payment? Well, we know that the firm will have a debt of $50 million. So the interest payment should be $50 million times 6%, right? So what you can see here is, so the K here is $50 million times 6% divided by free cash flow 3.8. So let's see what is the K here. The K is given by this number. So 78.95%. And now you can see that we have got all the numbers we need, right? We have corporate tax rate TC, and we have the ratio K, and we have the unlevered value, which is $76 million. So now we could basically plug in these numbers, and we find out the levered value is $100 million. Okay. And then there is the other case, that is the case with predetermined levels. So just by the name, you can see that under the policy of predetermined debt levels, the firm will change its debt level according to a fixed schedule, which is known in advance. So there are no uncertainties about debt levels in the future. Now let's see the, again, Avco example. So let's say the firm Avco plans to borrow $30.62 million, and then it will reduce the debt on the following fixed schedule. Again, you can see that this is fixed schedule, and you will know the debt levels in advance, so there are no uncertainties. Right? So the schedule works like this. It will have $20 million after 1 year, and $10 million after 2 years, and 0 after 3 years. So you can see that this is the fixed debt schedule, right? That is initial level of 30.62, and on the first year, it reduces to 20, and then at the second year, it reduces to 10. So given this debt schedule, then we could simply calculate interest tax shield, right? For example, if first year's debt is 30.62, then the interest we need to pay is this amount times 6%, which gives us 1.84, right? This number here. And then 1.84 times the corporate tax, the 40% tax rate. So now we have this 0.73. And then you can see that we could do the same with other years, right? So this times 6% give us 1.2. 1.2 times 40% gives us this. So you can see that if the firm has a fixed schedule, it's also very easy to for you to find out the interest tax shield. So we now want to discount these interest tax shields to find out the present value of the firm's interest tax shield. Now we have these cash flows. The question is, what discount rates we should use? Should we still use the unlevered cost of capital? Remember that when we assumed if the firm maintains a constant debt value ratio, or the firm maintains a constant interest coverage ratio, when we are using the APV method to discount the interest tax shields, we should use the unlevered cost of capital, right? However, in this case, you should not use the unlevered cost of capital. You should just simply use the debt cost of capital, right? So let me first state the result here. When debt levels are set according to a fixed schedule, we should discount these interest tax shield using the debt cost of capital. This is fairly intuitive, right? Because as I emphasized before, these debt levels, they're predetermined. There are no uncertainties. So the only risk is the risk of the debt itself. So that's why you should discount these interest tax shields using the firm's debt cost of capital. And for Avco, we know that its debt cost of capital is 6%. So we will discount these three numbers at 6% discount rate. Okay? So this gives us a interest tax shield of $1.32 million. And then we could calculate the levered value of the project using the APV method, right? So we see that, so we have this VU here. I think this one has been calculated before. So we have this VU here, right? Then plus this present value, this gives us the firm's levered value. And then another special case is if the firm has permanent fixed debt, then the levered value of the project will be just unlevered value plus the corporate tax rate times debt level. So we pretty much discussed about this formula in corporate finance 2. And here you can see that if you look at this formula, you can see that it's, again, essentially using this APV method, right? Essentially, it means that if the firm has permanent fixed debt, then its interest tax shield has the present value of corporate tax rate times debt level. Well, you can see why this is the case. So let's assume the debt is riskless. Then you can see that if the firm has the debt of D at each period, then its interest payment will be given by D times risk-free rate. Then its interest tax shield will be given by the interest payment times the corporate tax rate, right? And then if the firm has permanent debt, it means the firm will get this interest tax shield forever, right? So to value this, it's essentially a perpetuity, right? We will discount this at the debt cost of capital, right? It's RF. So this gives us D times tau C. So that is present value of the interest tax shield is given by the level of debt times corporate tax rate. Okay, that's for today's class.